If you are a UK investor, chances are you've thought about investing in the US. And rightly so, it's the largest economy in the world, home to some of the biggest and most innovative companies out there. But with so many choices and a few extra things to consider as a UK-based investor, where do you start? I'm here to help break it all down. The US stock market makes up around 60% of global equity markets. So whether you're investing for growth, income, or diversification, it's simply too big to ignore. From technology giants to consumer brands and healthcare innovators, the US market is broad, deep, and packed with potential opportunity. And the best bit? You don't need to buy individual shares to get involved. You can get exposure through ETFs or exchange-traded funds, which track baskets of US companies. Let's start with the S&P 500 Index, probably the best-known US stock index. It tracks the performance of the 500 largest companies in the US, ranked by market capitalization, which is just a fancy way of saying the total value of a company's shares. So when you invest in a fund that tracks the S&P 500 Index, you're getting broad exposure to the overall US economy, from technology and energy to healthcare and finance. Then there is the Nasdaq-100 Index, which is made up of the 100 biggest non-financial companies listed on the Nasdaq Stock Exchange. Now, most people think of this as a technology index, and while it is true it is tech-heavy, it's not just about that. It also includes names from retail, healthcare, and communication services, for instance. In short, both the S&P 500 Index and the Nasdaq-100 Index offer diversified exposure to US companies, but the Nasdaq-100 Index leans more towards innovation and growth. But the US stock market isn't just about big names. There are thousands of smaller companies with real potential, and that's where mid-cap and small-cap indices come in. The S&P 400 Index covers medium-sized businesses, also referred to as mid-capitalization or mid-cap companies. The Russell 2000 Index and the S&P Small Cap 600 Index cover smaller firms, also called small capitalization or small cap companies. These companies tend to be more focused on the domestic US economy rather than international markets. So if you are looking to diversify beyond the global mega brands, this could be an area to consider. You can also zoom in on specific sectors. For example, if you are interested in US technology or healthcare, there are indices and ETFs designed to give you exposure to those specific sectors. Similarly, you can also choose to tilt your portfolio towards themes and trends you believe in, whether it is artificial intelligence, aging population, or clean energy. Right now, a big chunk of returns from the S&P 500 Index are being driven just by a handful of companies, often called the Magnificent Seven. That includes the likes of Apple, Amazon, and Nvidia. It's impressive, but it also raises something called concentration risk, where a small number of stocks have an outsized impact on the index. One way to reduce this risk is through equal weight indices. Instead of giving more weight to the largest companies, they weight all stocks equally. It spreads your exposure more evenly and can offer a different performance profile. Another way to manage US concentration risk is by investing globally. Global indices like the FTSE World Index still include US stocks. In fact, the US market makes up about 60% of this index, but it also includes Europe, Asia, emerging markets, and beyond. So if you are looking for US exposure as a part of a broader strategy, global equity ETFs could be an option. As a UK investor, one extra factor to think about is currency risk. When you invest in US stocks or indices, your returns are affected by the exchange rate between the pound and the US dollar. If the pound strengthens, your US investments could fall in value, even if the share prices stay the same. Some ETFs offer currency-hedged versions, which aim to reduce this impact. It's not essential, but worth understanding depending on your outlook and goals. When choosing an ETF, you might come across two structures: physical and swap-based. Physical ETFs hold the actual stocks in the index. Swap-based ETFs use a financial contract called a swap between the ETF and another party, usually a bank, to receive the performance of the index. Now, swap-based ETFs can offer certain tax advantages, especially when it comes to withholding tax on US dividends, but they also carry counterparty risk because there is another party involved in the contract. ETF providers like ourselves at Invesco manage these carefully using multiple counterparties and strong risk controls. To sum it all up, the US stock market forms a large part of global indices. There are options offering exposure to large, medium, and small companies, and even to specific sectors and themes. But it's important to be aware of the risks, like concentration and currency exposure, and to choose an ETF structure that fits your needs. At Invesco, we provide a wide range of ETFs to help UK investors access the US market efficiently, confidently, and in a way that suits their goals. To get started, explore Invesco ETFs on InvestEngine and see how easy it is to bring the US market into your portfolio.